Hi viewers, Namaste. As we have understood what to observe and infer from an income statement and a balance sheet, we will now discuss about the financial ratios. Of course, these ratios are derived from the data of these financial statements itself. So, why financial ratios? From an investor point of view, there are mainly two reasons. One, to make our analysis summarized and simplified. Two, to compare the financials of one company to another. Because comparing two companies in absolute numbers is many times illogical, as even companies in the same sector vary in different aspects like size, etc. Before starting our topic, one important thing to note in mind is ratios alone do not give a complete picture of a company's investment potential, but they are a wise place to start the analysis. In other words, ratios do not provide answers, they suggest possibilities. So, let's start this series by knowing what exactly is financial ratios, what does ratio analysis tell us, and how are these ratios categorized. So, welcome to the world of Gettrading. First question, what is ratio analysis? Ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, profitability, etc. In our previous videos, when discussing about income statement and balance sheet, we have discussed all the possible 4 account types or transactions, that is, assets, liabilities, revenues, and expenses. Of course, equities too, but we now know that equities is equals to liabilities. If you haven't seen those videos, please find its link in the description box below or in the I symbol above. Ratio analysis is nothing but comparing these factors, adding share price to, at their logical levels. Next, what does ratio analysis tell you? The data retrieved from the statements is used to compare a company's performance over time to assess whether the company is improving or deteriorating. To compare a company's financial standing with the industry average, what we call peers. Or to compare a company to one or more other companies operating in the same sector to see how the company performance is. Many analysts use these ratios to review sectors too. Now, ratio analysis categories. As said, to get logical conclusions, there are n number of financial ratios. They can be categorized into 6 main groups based on the type of analysis they provide. 1. Liquidity ratios. 2. Solvency ratios. 3. Profitability ratios. 4. Efficiency ratios. 5. Coverage ratios. And 6. Market prospect ratios. Let's see quickly what does these categories mean and what they offer. First, the liquidity ratios. Liquidity, in general financial term, describes the quickness at which an asset or security can be sold quickly to convert it into liquid cash. So, as the name suggests, liquidity ratios measures the ability of a company to meet its short-term debt obligations using the company's current or quick assets. Current assets and current liabilities, which we have seen in the balance sheet, are the key players in these types of ratios. In layman terms, we will see from these ratios what portion of current assets of a company should be converted into cash to clear off the current liabilities. By considering full or only few portions of the current assets, examples of these ratios are current ratio, quick ratio, working capital ratio, etc. We will surely discuss about each ratio in depth on our coming videos. Next, solvency ratios. Solvency, in general financial term, is the ability of a company to meet its long-term debts and financial obligations. So, as the name suggests, solvency ratios compare a company's debt levels with its assets, equity, and earnings to evaluate whether a company can stay afloat in the long term by paying its long-term debt and interest on the debt. In simple terms, solvency ratio indicates whether a company's cash flow is sufficient to meet its short and long-term liabilities. Solvency ratios are also called as financial leverage ratios. Examples of these solvency ratios include debt to equity ratio, debt to assets ratios, and interest coverage ratio. Next, profitability ratios. These ratios show how well a company can generate profits from its operations. We have discussed maximum profitability ratios in income statement video itself. Some more ratios need a blend of income statement and a balance sheet numbers too. Examples of profitability ratios are net profit margin, return on assets, return on equity, return on capital employed, etc. Next, efficiency ratios. Efficiency ratios are used to judge the management of a business. Also called as activity ratios, efficiency ratios evaluate how well a company uses its assets and liabilities to generate sales and maximize profits. Key efficiency ratios are the asset turnover ratio, inventory turnover ratio, and days sales in inventory. Next, coverage ratios. These ratios measure a company's ability to make the interest payments and other obligations associated with its debts. Coverage ratios might seem a lot like liquidity and solvency ratios, but there is a distinct difference. Coverage ratios are an important financial ratios from the viewpoint of the long-term creditors and lenders. Some examples include the times interest earned ratio and the debt service coverage ratio are both examples of coverage ratios. Next, market prospect ratios. The ratios we have seen till now are the ones which concentrate on the internal aspects of a company. But these ratios will consider the sentiments of an investor and markets too. That is, it will consider the price of the stock too. These are the most commonly used ratios in fundamental analysis and include dividend yield, PE ratio, earnings per share, and dividend payout ratio, etc. Investors use these ratios to determine what they may receive in earnings from their investments and to predict what the trend of a stock will be in future. As said, all these ratios will be discussed in depth in our next videos, one by one. Please stay in touch with us. How? By subscribing to our channel and pressing the bell icon. Have a happy, safe and profitable trading. Jai Hind.